February 2020. A letter reaches a sailing magazine in Connecticut. 3 paragraphs about a marine insurance policy and 1 question about a mast. The man who wrote it had paid premiums for 47 years and never filed a claim. He had just worked out that his hull coverage was worth almost nothing. His policy still said agreed value across the top of the page. Have you ever actually read the depreciation section of your own boat policy? Put what it says in the comments. Yachts and Boats goes through the documents almost nobody reads. Subscribe so you catch the next one. His name was Ron Russell, and his boat was 47 years old. He wrote that a change in underwriting meant he had virtually no hull or damage insurance left, and that his premiums had gone up anyway. His question was simple. If the mast came down while the boat sat at anchor, would the policy pay 20% of the repair bill? The magazine took that question to the insurer, and the insurer answered it on the record in print. That answer is the reason this video exists. The reply ran in print on the 27th of March, 2020, written by an insurance expert at BoatUS Marine Insurance named Mark Pellerin. It did not dodge the question. It laid out, category by category, how the policy settles a partial loss, and it announced changes that were already taking effect that month. Insurers almost never explain this in public. Most owners learn it from an adjuster after the damage when there is nothing left to decide. The part that gets me is what had actually changed. His boat sat where it always had, surveyed, maintained, every fitting exactly as it was the season before. The paperwork changed. The policy Russell held was the BoatUS Marine Insurance Program, underwritten by GEICO Marine Insurance. It was an agreed hull value policy, which is the coverage most owners believe protects them fully. Agreed value means the insurer and the owner settle on a figure when the policy is written. If the boat is a total loss, that figure gets paid. No argument, no depreciation. That is the part everyone understands, and it is a genuinely good feature. On a total loss, it removes the argument that dominates car insurance, where the company's valuation and the owner's valuation never match, and the owner absorbs the gap. Agreed value settles that fight in advance, in writing, before anything has gone wrong. The part almost nobody understands is that agreed value describes one situation and one situation only: a total loss. The boat gone, sunk, burned, unrecoverable. Everything short of that is a partial loss, and partial losses do not settle under the number on the front of the policy. They settle under a schedule. Here is where a single hull stops being a single thing. Under that policy, a boat splits into 3 separate categories, and each one settles differently. Hard goods covers the structure: fiberglass, wood, masts, spars, paint, rails, stainless frames. Soft goods covers everything woven or sewn: sails, canvas enclosures, carpeting, cushions, fabric. Machinery covers what moves: engines, generators, the mechanical systems below deck. One boat, 3 settlement regimes running at the same time on the same hull, and they do not agree with each other. Take a canvas enclosure and the stainless steel frame holding it up. They are bolted together. They get damaged in the same incident, by the same wave, in the same 5 seconds. They belong to different categories. They settle under different terms. Same claim, 2 answers. You cannot see any of this from the deck. There is nothing on the boat that tells you which category a component falls into. Hard goods carry their own history. Under the policy Russell held, structural repairs were depreciated as well, which is what produced his 20% question in the first place. The company later introduced an endorsement waiving depreciation on some of those items, including masts, spars, fiberglass, railings, and stainless frames. Several readers of that magazine wrote in afterwards to say they had never been told any such endorsement existed. A protection nobody knows about is functionally identical to a protection nobody offers. The categories were always there. What changed in March 2020 was when the clock starts on each one. Under the old policy, soft goods began depreciating in the 20th year from the date of manufacture. Machinery, the same. 20 years, then depreciation began. In mid-March 2020, the updated GEICO Marine agreed hull value policy moved those dates. Sails, canvas, carpeting, cushions, and fabrics now begin depreciating from the 6th year of manufacture. The 6th year. Most 6-year-old boats are still on their original canvas and factory cushions, and plenty of them are still under a payment plan. From that point forward, every claim involving anything sewn or woven comes back reduced, and the reduction grows with every season the boat stays in the water. Machinery moved from the 20th year to the 11th, with depreciation capped at 80%. And the depreciation waiver, the endorsement that had protected owners of older boats, was withdrawn entirely for any vessel beyond 20 years of manufacture. Russell was reading a policy that had been rewritten underneath him, and it was not the first rewrite. Before 2015, the policy applied depreciation only to specific named items that genuinely wear out. From 2015, it applied depreciation to every partial loss after a set period. The 2020 change moved back toward named items, but started the clocks far earlier. 3 different structures inside a decade, on a contract most owners sign once and never open again. The premium notice arrived every year. The terms underneath the premium did not stay still, so depreciation applies. That much is settled the moment you read the schedule. What no owner can easily find out is how much that schedule takes when something breaks. That number is harder to find than it should be. Most boat insurers use an unpublished depreciation schedule for partial losses. The owner cannot look up the percentages before a claim. They find out during the adjustment, which is the worst possible moment to learn what your policy actually does. A few carriers do publish worked examples. United Marine Underwriters is one of them, and their example is worth walking through slowly because the arithmetic is the entire story. A stern drive fails. Replacement cost $8,000. The schedule applies 7.5% depreciation per year. After 8 years, that is 60% gone. $8,000 minus $4,800 in depreciation minus a $500 deductible. The owner receives $2,700. The repair costs $8,000. The policy pays $2,700. The boat is 9 years old. That is not an old boat by any definition an owner would use. That is a boat still being financed. Canvas runs faster, around 15% a year on some schedules, which means a suit of canvas is worth a fraction of its replacement cost long before it is worn out. And underneath all of it sits a flaw. Under the BoatUS actual cash value form, residual value stops at 20% regardless of age. 20% is not the disaster scenario. It is the guarantee. It is the number the policy promises you will not fall below, which means it is also the number the policy is steering toward on any boat old enough. Russell asked whether his policy would pay 20% of a repair. He had read it correctly. That number is the flaw, not the exception. Does that change how you read the words agreed value on your own policy, or did you already assume it worked this way? There is a second mechanism underneath the depreciation schedules, and it is worse because it turns a small failure into a total one. Roughly half of all sinkings happen at the dock, not in weather, not offshore. Tied up, with nobody aboard. The cause is almost always a small component below the waterline giving way. An outdrive bellows is the standard example. A rubber part, a few $100s, one of dozens on the boat. It fails from wear, tear, and corrosion. Wear, tear, and corrosion is an exclusion. The policy does not cover the part, but the boat is now on the bottom of the slip. The $200 part is not covered. Whether the $60,000 boat is covered depends entirely on whether the policy carries consequential damage coverage, which pays for losses that begin with an excluded component. Without it, an excluded part takes the whole vessel with it. And then there is salvage, which most owners have never priced. Getting a sunken boat off the bottom and to a yard is expensive, and carriers handle that cost in very different ways. Some subtract salvage from the insured value, which means the recovery bill eats into the money meant to repair the boat. On some policies, only a small percentage of insured value is available for recovery at all. The boat comes up, the payout goes down. So far, this has all been about what happens after damage. The harder problem arrives before any of it, because every one of these calculations assumes somebody was willing to write the policy in the first place. Underwriters set age limits on hulls, and they apply them regardless of condition. Some carriers decline boats over 40 years old, others cap at 30, some stop at 20, not 20 years of neglect. 20 years. A boat surveyed last month, kept immaculately, refitted throughout, gets declined on the model year alone. Before that, the survey ladder starts. Most insurers require an out-of-water marine survey once a boat reaches 20 years, and some ask from 15. Past 30, it is close to automatic, and a fresh survey is typically required every 5 years after that. An insurance condition and valuation survey runs $18 to $25 per foot. Hauling the boat to inspect below the waterline adds $10 to $20 per foot on top. Surveyors carry minimum charges, commonly $450 to $500. On a 40-foot boat, that is a recurring 4-figure cost every 5 years for the privilege of being allowed to keep paying premiums. And the escape hatch closed on a date you can look up. The endorsement that eliminates partial loss depreciation on soft goods and machinery up to the 20th year is still available. It can only be added to a boat no more than 10 years of age. The people this endorsement would help most are the ones who cannot buy it. An owner who works out the exposure at year 15 is already 5 years past the cutoff, and the door shut long before he knew there was a door. By the time the clause starts costing you money, buying protection from it is no longer an option you have. I have read the company's reasoning on every other point in this policy and found most of it defensible, not this one. The people most exposed to depreciation are structurally locked out of the product that prevents it. The insurer's position on all of this is coherent, and it deserves stating properly. Soft goods have the shortest working life of anything on a boat. Salt, sun, and constant movement destroy canvas and fabric faster than any other component. Replacing decades-old material with new material at no cost to the owner is not supportable at a competitive premium. The company described the March 2020 structure as a return to how the policy worked before 2015, with depreciation applied to specific items that genuinely wear, rather than blanket, applied to everything. Owners who keep receipts documenting repairs and replacements can reduce the depreciation applied, and not every carrier operates this way. Chubb exempts hulls from annual depreciation, including older hulls, with no added endorsement required. Terms vary enormously between insurers. The only document that governs your boat is your own policy wording, and this video cannot tell you what it says. But there is one more layer, and it is the one that turns all of this from an insurance story into a money story. Boats do not lose value on a smooth curve. A new boat sheds 10 to 20% in the first year. By year 5, it typically holds somewhere between 50 and 70% of its original value. By year 10, 30 to 50% is gone. Then the decline should flatten. The hull is fiberglass. It does not rot, it does not rust, and a well-maintained boat at 15 years is mechanically capable of another 30. Instead, the decline speeds up again through the teens and 20s, before bottoming out somewhere between 10 and 30% of original value. In April 2026, BoatUS published its own explanation for that second acceleration. They tied it partly to insurance restrictions that attach to vessels at fixed birthdays, the 20-year mark, the 25-year mark, the 30-year mark, which inverts the entire thing. The standard assumption is that insurers restrict coverage on old boats because those boats have lost value. The sequence runs the other way as well. A buyer who cannot insure a boat, or who can only insure it under a schedule that pays 20%, will not pay what the boat is worth as a vessel. They will pay what it is worth as a risk. The clause does not simply describe a boat becoming worthless. It is one of the forces making it worthless. The underwriters are not inventing that risk. Hurricane Sandy, Harvey, and Irma together account for roughly 128,000 damaged or destroyed recreational boats and around $1.3 billion in boat-only losses. That is the loss experience the schedules are priced against, and it is real. Whether that justifies a 6th-year start date on canvas is a question the industry and its customers have never actually settled. What is settled is the direction. Going into the 2026 season, the yacht insurance market remains constrained, with tightened terms and limited capacity across Florida, Texas, the Gulf Coast, and California. Ron Russell asked one question about a mast, and the answer he got was published 6 years ago in a magazine most boat owners have never opened. The schedules at every other major carrier are still unpublished. Nobody outside those companies knows whether the same clocks were quietly reset because there is no requirement to announce it and no central place to look, which puts the real valuation of your boat in a drawer in 12 pages of policy wording you have never opened, written by the only party whose opinion actually pays out. That document is the next thing Yachts and Boats takes apart, line by line. Subscribe so you are there when we do.